Hey, Annie, guess what?
What?
We just launched a Business of Biotech newsletter.
Yeah?
Yeah. I know what you're thinking.
What am I thinking?
We don't need another newsletter.
Yeah, I might have been thinking that.
Annie, I swear on my grandpa's grave, you're going to like this newsletter.
That's a pretty bold swear, Matt.
Hear me out. It's monthly, only once a month. It's ad-free, and it's modeled after the Business of Biotech podcast. It's got the same insight from the builders of biotech that you see in the podcast. So what's not to like?
That actually sounds like it doesn't suck.
Pretty high praise, Annie. Check it out. bioprocessonline.com/BOB. Go there and sign up for this newsletter. You won't regret it. That voice you heard me talking to on the spot that played before the episode is Annie Murphy, multimedia producer extraordinaire. And Annie's not here right now, but Miles Skoda, my man Miles Skoda sure is. Say hi, Miles.
Hey, guys.
Miles, now that we've dropped that first issue of the Business of Biotech newsletter, can you please validate for us that it in fact doesn't suck?
Yeah, it definitely does not suck. It's great.
I appreciate it, Miles. Take Miles' word for it. Go check it out at bioprocessonline.com/BOB, our new Business of Biotech newsletter. So it's been a minute since we had my friend Allan Shaw on the show, and boy, is this a good time to change that. We're starting to see some cautious optimism creep back into a biotech finance scene that was mostly Debbie Downer in 2022. And as we turn the corner on a new year, there's no one better to give us a read on how those tides might be changing. So backed by popular demand and timely demand is my friend Allan Shaw, everyone's favorite biotech CFO, board member, and advisor. Allan, how you doing?
Good morning to you, Matt. Doing well, and great to be back.
Yeah, well, it's great to have you back. We had a little bit of a hiatus there. Just we both got busy with things. You were doing a bunch of stuff. I was doing a bunch of stuff, and one day I looked up and I was like, "Where's Allan been? I got to get him back."
Glad to reconnect, and always have time for you, and love to catch up.
Yeah. One of the things that took you, occupied some of your time, I should say, a little bit earlier in this quarter was you're invited to speak on a panel at BioFuture in New York, but the BioFuture event in New York. And some of the fodder from that panel is going to be what we build our episode around today. Before we jump into that, though, I want to learn a bit. I wasn't at the event. I've heard good things about it. I've heard it was well attended. I'm assuming it's sort of resurgence of something post-COVID. But tell me what you know about it. What's the event all about, and how did you get involved in BioFuture?
Thanks, Matt. It's a really nice event. It kind of comes before JP Morgan. It's sponsored by many of the folks behind the Biotech Showcase at JP Morgan. Mm-hmm. And it's really it's an independent conference. So, no one's wearing jerseys like an investment banking conference. So you get a lot of it's an independent conference, and you get people from different banks, you get different companies, you get industry actors. And it's really a nice place to gather and share thoughts and learn from each other's experiences. And they run a number of different panels. They have a number of different areas where companies present, both public and private. And this is the second year that it's been in place. It started it originally was initiated before COVID, but suffice to say, COVID got in the way of a lot of things, including this. Yeah. So they had the inaugural conference last year, and this year they had, from what I understand, they had at least two times the number of people from last year. So it's a conference that appears to be gaining momentum. And like I said, there were a lot of folks from industry there, and we were able to get together and exchange thoughts and ideas.
Good deal. Well, if anyone from BioFuture is listening, I'll appreciate an invitation next year. I'd like to be able to attend that event. So
I'll put that in the suggestion box.
Please do. Yeah, you've got some influence there now that you've invested your time and expertise on one of their panels. That panel that you sat on was titled "Funding Innovation: What is the New Normal?" And when I read that, with my editor's hat on, prior to hosting a podcast, I spent all my time at a desk just editing and writing. And I looked at that and I said, funding innovation, you could take that two ways. You could say you're either innovating you're either discussing innovative financing vehicles or you're discussing how to fund innovative ideas. What was the driver there? What was the point?
That's a really thoughtful observation, and I think really it was ambiguous because you are talking about the nature of our business. The business of biotech is innovation, generally speaking, and so you're certainly looking at how are you going to be able to move the chains and make impactful developments that can help patients. On the other hand, when you're in a bit of a financing route right now or drought, you need to be a lot more resourceful and innovative in the way you think about capitalizing your company. I think it goes also into the way you develop and the way you approach resource allocation as well. I think you need to be, somewhat thoughtful and innovative. So I think it's a transcending term. But this conference both talked about, how do we continue doing what we want to do and to be impactful? And at the same time, the most rate limiting factor, I think, is capital. I mean, there's other considerations, but certainly on my short list, capital would be right up there.
Yeah. And I want to just give a shout out. I want to, you're on this panel with some other execs. I want to give a shout out to those execs because we're going to reference a few of them here as we talk. One of them was Rochelle Jacques, who joined me on the show just a few weeks ago, and so gracefully and graciously put up with my diatribe about hitting ticks. I don't know if you may recall that episode. Rochelle Jacques, CEO over at Akari Therapeutics. Sean McGregor from JP Morgan, Peter Rehnquist from Zoma, and Barbara Ryan at Barbara Ryan Advisors. We're all on the panel with you, as well as moderator Tim Oppler from Torreya. So they recapped, Tim, in fact, recapped some quote-worthy nuggets from this discussion not too long ago in a write-up that he did. And that coverage has been getting some buzz on social and other places. And I figured it'd be fun, Alan, to kind of recap a few or reflect on a few of those nuggets that made their way from the panel to social and other mediums and have been generating some commentary and response. We're going to start by picking on a couple of the panelists, and then I'm going to pick on you a little bit by sharing some of your quote-worthy sound bites and giving you an opportunity to kind of extrapolate on them. Does that sound right? Is that fair? You game for that?
Sure. Sounds like a plan. Let's go.
All right. So I'll begin with, I'm going to begin with the thought that Barbara Ryan offered on the denominator. I put that in air quotes, right? The denominator. This was a resounding theme that came out of the panel, but speaking about why the biopharma sector, quote unquote, feels so bad, which there's probably not a whole lot of disagreement there over the course of the past 18 months. Speaking about that, Barbara posited that the denominator, in other words, the volume of biopharma companies, has risen substantially, effectively doubling every 8 years, I think, is some context around that, resulting in more mouths to feed. So just, we've got a glut, if you will, of biopharma companies. In your purview, how has fast growth in the number of biotech companies contributed to this melancholy, that's putting it nicely, tone?
Now, Barbara hit on a really salient point, and a point that was also raised by Bruce Booth recently during his year in review. That's on YouTube. I would recommend that to anybody who's listening. Yeah.
Let me just, anybody who's listening, Atlas Ventures Year in Review, I think, Atlas Venture Year in Review, just search that up on YouTube and you'll get to it.
They both touch on it, and Barbara really hit on it, was that there's been the proliferation of companies during this go-go period of time has been really unprecedented. We really have had an unprecedented period of time over these last 10 years, and it really accelerated, in the last 5, where we've just had company proliferation. You've often heard me quip, quoting our dear friend Rob Wright. It was the boy bands of biotech that were just parading out. So as a consequence, every company that you put out there has a financing overhang. There's no such thing as a fully funded biotech company. So when you have that number of companies out there, you've increased the universe by orders of magnitude. So that, I think, was really Barbara's point. So even if you've got a higher number of M&A deals, and you put that over the number of companies out there, proportionately speaking, it's a little underwhelming. Getting a deal, I think really where Barbara was going is almost, it's not quite again like winning a lottery ticket, but the probability of that happening has shifted a lot. And consequently, that also increases the cost of capital, and we can come back to that. But I think those were some of the general themes overriding that, and I can elaborate and elucidate if we want to drill further.
Well, one follow-up question I have for you on that is this. So, if you look at it in simplistic terms, we're seeing more sort of modality advance, more complexity, specifically in biologics. More complexity, more modality advances. You would think that as technology improves and develops, the technology part of it could support a broader landscape, a deeper landscape, perhaps, of companies. On the flip side of that, we're seeing some clusters around specific technologies or modalities that are overripe, right? Like that are that have expanded a bit, probably too far to be healthy. So where's the balance there? Reflect on that for us a little bit. Like, given the advances in science and technology that should support a boom of companies, why are we seeing so much kind of, imbalance in these clusters of companies that are grouped around specific targets and modalities?
It's a great question, and it really it's a lightning rod question, because it really touches on resource allocation and it speaks a little bit to the malaise that we are in. Bruce called it out in his presentation in terms of, I think there's over 110 companies running CD19 CAR-T CD19 programs. You see it with the checkpoints, the commercialized checkpoints, where you've got at least 14 approved in the US, you've got others approved elsewhere in the world. And what you're doing is you're commoditizing really, really good and innovative science. And you're also, so those are the companies that have gone to the finish line. They're commoditizing themselves on that front. And then you've got these other folks, these other 110, slugging it out, and they're competing. It's really almost a gladiator sport, competing for capital. And people have to discern. I think there's going to be a level of Darwinism just in that target, and I think, as Bruce rightfully pointed out, it's not limited to that. That you can look at a lot of other targets where you've got a rather crowd effect in development. And us as an industry we have to think about, because that really reflects a lot of siloed development, right? People are not looking outside their four walls. They don't understand necessarily the competitive landscape. They're in love with the science, but they don't understand that this is a business. And that's somehow got lost in translation.
Yeah. And maybe 2018, 2019, pre-inflation, interest rate issues. No one really cared. No one really batted an eyelash at that. Like, hey, let that, let CD19 go crazy. We'll fund them all. And now we find ourselves in a situation where it's not so liberal, is it?
No, money was free. I mean, you really had almost free money during that period of time. And you'll always notice when money is non-restrictive, the allocation of capital generally becomes less restrictive, and people are doing things that they probably shouldn't be doing. There's less collaboration. The bar gets lowered because people are doing things because they can. But there's been a fundamental shift. The sea has gone out on that, and now it's really, in my opinion, resource allocation is really fundamental to success. It's also fundamental to survival.
Yeah. All right, let's move on to another of Barbara's observations from the panel. She pointed out valuation volatility among preclinical companies, and this is something we're seeing. The chart from 2010 through today looks sort of like a, would you call it a helix? Like it kind of looks like it just kind of turns on itself, right? Break that down for us. Tell us what you're seeing in terms of that 180. That what I'm trying to visually describe, that 180-degree flip on valuations. I know that's a big question.
I think that what you're seeing there is a number of dynamics. I think on almost on the macro level, you've really seen a shift in resource allocation of the investors, the buy side, where there's really been a risk-off trade. And that's because the interest rates that have increased earlier in the year, we characterized as the canary in the coal mine. Regrettably, that poor canary has perished, and interest rates have moved up, and you've seen a reallocation of capital that has moved out of risky assets. And it's not just biotech. We've seen this in technology in general. And as I understand it, that the correlation is pretty significant. So it's misery loves company, but it really reflects the fact that there's a risk-off trade. Further to that, going back to the perhaps attributable to the free flow capital, we also had an interesting period, a long period where we had a lot of negative news flow. And one argument I would attribute to it is that people were doing things that they probably shouldn't have been doing. I would also say one of the issues that the industry is also challenged with is human resources. And when you have such a significant proliferation of companies, you're probably getting people in roles that are probably not necessarily all ready for it. So you couple the free flow of money with some inexperience or naivete, and it's not going to be overly surprising that you're going to get some negative news flow. It looks like at this point the news flow has gotten better. I think it's now a question: will it sustain itself a little bit? But if you look at it again on a macro level, you're not seeing it in valuations. I think there's over 200 companies, I believe, that are trading with negative enterprise value, which means that they're trading below their cash balance. Yeah. So that's not a pretty sight at all, and it's an incredible cost of capital burden for these companies too. So you'd have to look at each one of them individually. You can't generalize, but as a class effect, it's really going to be hard for them to be able to finance the company. If they're well capitalized right now and they can execute to their inflection points, and are fundamentally sound, they have those companies have nothing to worry about. The companies that are in that position that have to raise money right now, that's going to be highly punitive. And it raises other questions that we may touch on later on, because when you have that kind of punitive financing, it also creates a high level of dilution as well. So, when you're a small cap company and you have a negative enterprise value, you're not in a good place. But I would say, generally speaking, if your market cap is less than $500 million, you're challenged in this environment. It seems like the buy side is showing a little bit level of more engagement. So it's really going to be interesting to see where they are in the new year. For instance, and I think it all correlates to relevancy in data. It seems to me that the companies that can get out of that box sooner are ones that are going to have data in the near term. I was talking to a sell side analyst recently, and we're talking about, how far out are people looking on this,
Yeah.
because it's the relevancy of that is highly relevant, and the sad or the revealing question was that if you tell them that you tell a buy side analyst that you're going to have data in 6 months, well, they're going to tell you that they may not have a job in 3 months. So it's a tough environment where I would say there's a defensive psyche that's playing into it. So with data, people are engaging. Without data, it is harder. But the valuations, to succinctly answer your question after my long-winded ramble, is the cost of capital has skyrocketed.
Yeah. Yeah. Well, yeah, you definitely put a lot in there to unpack. And I really like I'm gonna call one of those Allan Shawisms a Yogi Berra Allan Shawism. The relevancy is highly relevant. I cannot overstate the relevance of the comment I just made. So one of you talked about we talk about cash runways a lot. You and I do. We've talked about the importance of cash management and burn rate management quite a bit over the course of our relationship. Barbara put a number to that kind of surprised me. You talked about those who have a restricted or shortening cash runway and no data being in a very, very precarious position. Barbara on the panel offered that 40% of the sector has less than 12 months of cash. If I'm part of that 40% of the sector that has less than 12 months of cash, and I don't have profound and extreme confidence in my data, I would probably think I'm in a pretty perilous position. And of course, we don't, we can't necessarily sit here and analyze the quality or relevance of that portion of the market's data, because we probably don't have access to that information. So just looking at that 40% of the segment having less than 12 months cash data point, what are your thoughts on that? What does that bode for those companies heading into 2023?
It says a significant financing overhang. I think Bruce touched on that too. I think he suggested that there's, I think like 100 companies right now that have less than 12 months cash. There's going to be 300 companies, I think, that will need cash, will have less than 12 months of cash in the next 12 months. Or whatever by the end of 23. So they all align with what Barbara is saying. And ultimately, the question I think out there is, will all of them have the ability to raise that cash? Mm-hmm. Again, going back to all the CAR T CD19 players, if you're in that box, how do you differentiate yourself? Why should somebody be writing a check for you? How are you going to win relative to everyone else? You might have good science, it may work, but is it clinically and commercially relevant? So, there's going to be some hard questions. I guess at some level, you can always raise money, right? I see companies limp along forever, doing these dilutive transactions. But, I think overall, it's going to put a pressure on the sector. Yeah. I think even if you're fundamentally sound, I think good companies will always have access to capital. You have good data, you're going to have access to capital. But I think when you have an industry where there are industrial jeopardies and failure rates that are higher than most, I think there's going to be a lot of continued dislocation. I think that weighs on the industry. My personal view is some of this has to work itself out. These companies in these situations have to kind of go down a couple of different paths. You have to figure out whether or not you really, and you got to be intellectually honest with yourself. You got to ask yourself, are we in the hunt? And do we have enough resources to get to an inflection point? And I think those guys are great. Stick to your knitting. You keep eating your cooking. But I don't think everybody falls into that bucket. I think there are different buckets, and people need to think about, how are they going to get to the other end?
Yeah.
Do they have the fundamental science and assets? Is there a program that they think that they can succeed with? And then, I think there's a number of companies. I think from my perspective, I've just gone through a reverse merger process, and we kind of tried to boil the earth. And again, I think this, again, going back to Bob Breer's denominator, I think you got more reverse merger strategic process going on as a numerator than you've ever had before. But relative to the universe of companies where I would say lights on, no one's home, it's not there yet. And I would say in those situations, that I would certainly urge those companies to kind of look inside and really honestly and objectively assess the best way to move forward, and try to be selfless about it, and take your own personal objectives and issues out of from the bias. Because I think, if you can hit the brakes and preserve capital and stop the overhead burn, you're actually creating value in a bad situation, because it'll improve what you have as a bargaining chip when you do look at strategic alternatives. And when you do strategic alternatives, you're rolling into a new opportunity. Mm-hmm. And a lot of that's going to be prefaced by the cash that you have, and that's a governing factor. Yeah. So, all of these factors, there's not one size that fits all. But I think we're in a period of time that, going back to the party, this is the debris of having a 10-year biotech party. And, there's some cleanup afterwards. We've talked about the hangover in the past, but think about after you wake up, that frat house after the party, there's a lot of beer bottles. After a 10-year party, I dare there be an infrastructure that would still be standing, much less, but I'm sure the bottles would still be there. And I would say a lot of these negative enterprise values are, using an analog, some of them are empty bottles.
When you're striving to excel in a new arena, the best guides are the ones already doing it well. The Business of Biotech brings those voices forward to help new and emerging biopharmas turn their innovations, like mRNA and cell and gene therapies, into clinical realities. Tune in and subscribe for insights on hiring, regulatory, and other need-to-know topics for biopharma leaders. The podcast is brought to you in collaboration with Cytiva. Check out their resources at cytiva.com/emerging biotech. That's CYTIVA.com/emerging biotech. Yeah. And you may have just, great analogy, by the way, empty bottles that are good for at least some semblance of some sort of recycling. Maybe there's some value left there. Nothing left to finish in the bottle, but maybe some recycling. And you may have just answered the latter part of a several part question I had for you based on one of your quotes from the Bioforum panel. In the recap that Dr. Oppler offered, he offered up some of your sound bites. As I said, some of them generated some interesting commentary on social. So I'm going to quote a few of those, starting with this one, and give you a chance to give us some Allan Shaw on Allan Shaw. So this is Allan Shaw saying, there's a good chance, and this is funny too, because if you look at some of the recap, like there's some juxtaposition here on the heels of one quote where perhaps, Rachel Jacques said, there's a lot of reason for optimism. I see some bright side, and it elaborates on that. Allan Shaw says, well, there's a good chance things get worse in the months ahead. Until we clean up the sector, to the point you just made, things aren't going to get a lot better. Too many companies have fallen into, quote, small cap hell, where it is very difficult to get out. So the questions I had for you, and as I said, you may have alluded to some answers to the latter part of this, but what do you mean by clean up the sector? What is small cap hell, and how do emerging bio companies get out of small cap hell?
Ultimately data rules, right? Mm-hmm. In God we trust, and in data we believe. I think we did touch on a little bit of that as I was chatting. I think we have some of these empty bottles that need to be recycled and cleaned up. I think I also said during the panel that at least for the short term, I view reverse mergers to be the new IPO. I think they're a real way for a lot of these companies that are stuck on the runway to get out. But I think for the reasons I mentioned, I'm not as optimistic going into 2023 as some other people. The macro backdrop has certainly picked up. I mean, the Fed has recently indicated that they're slowing down the pace of interest rate increases. People seem to be very happy on that, and that is overall good. But there's a lot of latency in all these things. I think there's a lot of people that in that assumption also believe that the Fed might even start reducing rates at the end of next year. I think that's a very optimistic scenario. I guess it on one hand, it does assume that we're going to have a recession, but it's complicated. So, I still think that the market backdrop may be getting better, but better relative to what? And I still think, we still have the bottles that are required. And as long as rates stay elevated, I question when you'll have the risk on trade again. So that's why I'm a little apprehensive in the near term. It kind of goes again back to all these companies that have financing needs. They have to come to market. They're running out of cash. What's that going to do to the sentiment? Is this going to turn into a food fight? So those are the things that I'm sensitive to, that until we kind of get past these things or resolve these things, I'm apprehensive, and I would certainly, as an observation, I noticed that these companies would fall into a category that I think people should, as a rule, generally avoid. And that's just kind of sit there and hope.
Yeah.
I don't think you can hope for the market necessarily to get better. It's not something that you can control. I think you need to control things that you can control, and not hope for external factors to come to the rescue here. M&A people look for. It seems from what I'm observing that M&A has gone back, is improving. But I would also say that the dollar value of those deals have been lower, they're in an aggregate amount, and highly concentrated. Pfizer has certainly led the way in a lot of them. There's a lot of money on the sidelines. And I think that's always been an ongoing question. Why isn't there more opportunistic acquiring of technology? And you've seen some. Portage did it recently as well, but I'd say as a general rule, it hasn't been as pervasive, and I think it comes back to the observation that there's a lot of duplication in the space, and that things aren't differentiated enough, and whether it's cheap relative to yesterday's prices. Is it cheap relative to tomorrow's prices? And I think people would rather, a lot of the big boys would rather purchase something that's been further de-risked than to necessarily take a risk. I think everyone's kind of in the sense of self-preservation, whether you're on the buy side right now. I'd say a lot of the financing, it is getting more robust for people with data. I think that is a fundamental distinction, that if you've got data, that you've got a game's on. But it's a little bit of an open book test now. People want to see the data before they come in. So so under those situations, I'd say there is a market. I'd say for the people that don't have the data, the financings can be highly dilutive, and that actually created a little bit of a debate, because I made a comment during the panel that you can't go bankrupt from dilution. right? And people were, and I still believe on that, right? There's, but people get hung up on valuations and other things, and we can dig into that a little bit further later on if you'd like. But the real point is that people, some of these finances get very punitive. If you're in small cap hell and you don't have data, and you have to do a deal where you have 100 or 200% warrant coverage. Some of these deals even have royalty rights built into them. They're very toxic. So, a general practice, and I think this is what caused some debate, is there's a debate that if the management's the stewards of the company, and if they do a capitalization that is very dilutive to the current shareholders, are they entitled to be re-upped on their equity in order to motivate them and incentivize them? So in that situation, if you want to be coldly objective, everyone wins, but the pre-existing shareholders.
Yeah, I was going to say that was the comment I had on your dilution comment, is that I could see where that would certainly ruffle some shareholder feathers. Yes.
So there's that consideration. So I guess when you look at it, there is to protect the company as a fiduciary. You got to do what you got to do at the end of the day, and you try to reduce your cost of capital as necessary. I think it's been very clearly demonstrated that the longer you wait and as you run your cash balance down, you reduce your cost of capital goes up. So as people sit around and wait, your cost of capital actually goes up. And even if you have good data, there's a likelihood, because there's such a significant financing overhang, that your stock isn't going to move. So, from my perspective, going back to the management point, you should be trying to address these things as early and as proactively as possible to avoid getting into that situation. So, I don't think you can generalize, but I think in terms of enabling a company to execute and create value, the only way you're going to do it is having gas in your tank. And that was the genesis of my comment about I've never seen a company go bankrupt from dilution.
Yeah. We've seen I've seen a number of the companies that I've recently covered on the Business of Biotech podcast and in Bioprocess online editorial content, exercising some of the controls that you reference, beyond raising new capital, some limiting factors around cash burn rate. We've seen some significant workforce reductions among some of the companies I've recently covered. We've seen some pipeline scale down, shelving or backburnering some candidates to focus on specific lead candidates. Are these things smart moves in your purview, like in the short and long terms? Some of these sort of like, hey, there may not be a lot of opportunity to raise or earn new money. We need to preserve the money that we have. We need to make some decisions that may result in a negative perception in the news. Are these necessary? Are they smart decisions? I know it probably varies from one company to the next, but just generally, what's your gut on that?
I think as a general observation, people got in front of their skis a little bit too much. Mm-hmm. Again, think about it on a personal level. If you have $100, how do you allocate your resources versus if you have hundreds of thousands of dollars? You're just going to be more carefree when you have more cash. It's just generally human nature. Yeah. So I think as a consequence, you saw people taking office space that they didn't need. They built out their organizations a little bit quicker than they needed. And I think now they're kind of right-sizing the organizations relative to what's realistic, It's like going to a smorgasbord, right? Don't you usually sometimes put too much food on your plate? You have big eyes.
Yeah.
More than you can eat. And I think when the spigot of cash was running, people had big eyes and they thought they could do a lot of different things. So I think, tightening the belt and right-sizing the organization, again, at the risk of a broken record, about the resource allocation and focus. I think those are sensible things to do. The other thing that I think people should really be doing, and again, I think we got away from it from all the reasons we just mentioned, was collaborations. That, collaborate. I've said it before, the shortest distance between 2 points is a shortcut.
Yeah.
And I think this is the environment to do it. You can you can certainly look at different ways of collaboration. If you can no longer develop all the programs of your science, you're focusing around a therapeutic area, you could certainly look at a partnership or a collaboration on what would now be considered a non-core asset.
Mm-hmm.
By doing that, it certainly helps further validate your technology, and you're allowing somebody else to do it on their nickel while you retain, the upside of any tails associated with that.
Yeah, I think that was to that point, the Atlas Venture year in review that we've been referencing. I think Bruce mentioned. I don't remember what the exact number is or time frame, but I want to say I'm paraphrasing. I want to say 70% of commercial wins in the last X years were the result of collaborative partnerships with, in many cases, young, new, emerging, early stage sponsors. So that point proves out in the data, I think, Alan, that you're making.
Exactly. And it should be more of it. People should think about these things around geography. I think there's ways that you can still do things, and it also brings money in that helps fund, the focus. What you view to be your value generators. So I think there's a lot of merit in doing this. I think it's a challenge for people because people are generally optimistic. We're believers in our space, and you do want to believe things are going to get better. And these are all people that have been highly successful during various courses of their career, and now they're coming across some adversity right now. And sometimes, a lot of people got to where they are because they've been able to power through adversity. I think it's really important to, maybe take a TV time out and look around and take a cold, hard, objective look at the competitive landscape and make sure that you're not rowing against or running against the wind or sailing against the wind.
Yeah. Well, in the time we have left, I want to flip to some bright side comments coming out of the panel. Get your perspective on those. A couple of your fellow panelists offered some optimistic thoughts on a turnaround. JP Morgan, Sean McGregor said, companies with good data, we covered this, I think, well in the last few minutes. Companies with good data are able to access financing now. Very good chance that we see the equity market turn next year. As I mentioned, Akari's Rochelle Jacques said, the markets are tough. You must work hard to access capital, but it can be done. She proved that, by the way, within, 6 months of her joining Akari. I don't remember what the exact number was, but they raised a sizable round to get that company going. She says, in the long run, there are good reasons to be fundamentally optimistic about our sector. So what are your, where do you agree with these statements and sentiments, and where do you perhaps hold maybe a little bit more reservation?
I agree with substantially all of it. And I am trying to take happy pills,
Yeah.
Opplin took me to task a little bit for being so negative. We had a little fun on that, but I was just trying to be, I guess, honestly objective, not brutally. But nonetheless, there is a lot of reasons to be optimistic. I think there's great innovative science, and for great science, for great programs that are impactful and relevant, there'll always be money available for that. Mm-hmm. I just think the word discerning, it's a much more discerning environment right now. And if you can't articulate your story to be differentiated, to be relevant, in a fairly fluid competitive landscape, I think that one you're going to be very challenged. But I think to Rochelle's comment, I agree that you can get things done. I think you can be creative. You know, there's always a market clearing price. I think, you know, you got to be aware of the market clearing price. I think there is sometimes a little bit of a disconnect from that. And I think people have to come to terms that, you know, yesterday's valuation was yesterday's valuation. And this is the price. This is the price that a blueberry is selling for today. You know, last year, blueberries were at this price. So I agree with fundamentally all of that. I guess the only question I would say, and again, the bankers, this is a theme that Tim Oplis said as well, is that they feel that the backdrop is improving. So, you know, I think I would say the jury's still out on whether the markets will be better next year or not. I haven't seen it on the buy side. I think as long as interest rates remain elevated, even if the pace of increase slows down, I think that's still going to create a risk-off trading environment for technology in general. So I think bottom line is cost of capital is going to be higher than we like it. But, you know, as long as you think out of the box, remain resourceful. You know, if this door is closed, we're going to open up a window. If the window is closed, we're going to open up the roof. Whatever it takes, you know, we're just going to get it done. And I think out of the box thinking is going to be what's required, and encourage people to manage the external factors in their environment as opposed to being managed by them.
Yeah. Final thoughts on that. Let's say it's a great point. You talked about hope. You know, it's a bad place to be, sitting around hoping for market conditions to change, for external factors to, you know, for a tide to turn. And some of those things, you know, we recognize are well out of our control. But are there things that biopharma leaders can be doing proactively to enable change and maybe capitalize on change that they're enabling, or leveraging something to contribute, I guess, to that tide shifting? You know, if not, no, but as we turn the corner into the new year, you know, what should biopharma leaders be doing to enable or catalyze positive change?
You know, that was a bit of a $1 trillion question.
I know. Unfair of me to ask.
On a macro level, you know, we as an industry, there's an opportunity for us to think about how we, and again, I don't know how this would work in practice, really. I think that's the devil. But, you know, figure out how, as an industry, we allocate resources, because there, you know, a point that I've been focused on, I think Bruce also made it that point very well in his presentation, is the allocation of resources on therapeutic areas. You know, we talked a little bit about target accountabilization, but there's a lot of money being spent on oncology, rightfully, but should it be 50% of the pipelines that are out there right now versus cardiovascular, which is really related to many more, mortalities. So I think there needs to be probably more emphasis on chronic diseases than they are, but that speaks to our insurance system, which is really organized for acute care, because it's organized around employment, where they're underwriting risk associated with employment 2 to 5 years. So that's another episode in it.
It is another episode. So is that disconnect with global disease burden. I mean, I talk to so many ATMP, business leaders in the ATMP space who focus on rare and orphan diseases, and oftentimes oftentimes that's tied directly to a business strategy. We're a small company, we're virtual, we have 6 people, we have 8 people, we have some good science. We can't afford to take a big swing. There may be applicability in the technology to some of these big high burden disease areas, but from a strategic standpoint, it doesn't make any sense. You just can't do it.
No, and it comes down to how we develop drugs and how we get them approved. And, it goes to the point that, particularly cardiovascular, right? You got to break it down, just like we've broken cancer down to where there's so many number of different breast cancers, right? It's not just breast cancer. As an example, you got to break the heart down in a similar way. You can't, because right now, because it's considered a primary care kind of area, the clinical studies that you have to run for this 20,000 people or greater, it makes that burden of studies versus an orphan disease or oncology where you're looking at, different decimal point on these studies. It's just not cost effective. So people, you follow the money. So, there's a lot of different consequences that affect resource allocation again. But those things are industry-wide issues. I think as leaders, I think they should certainly, again, be mindful of the competitive landscape as you're allocating resources, as you're looking at your differentiation. Because I think we're in an environment now that works, but it's a discerning environment. And if you can't differentiate yourself, back to Barbara's point, you're going to get lost in the shuffle.
Yeah. Yeah. So many good topics for you and I to chew on in 2023. I look forward to doing that with you, Alan. We're going to, shortly after this call, after this recording, we're going to get together and we're going to map it out. We're going to map it out, our 2023 Allan Shaw episodes of the Business of Biotech, because there's a lot to digest, a lot to talk about, and I love your perspective. I always appreciate you for coming on.
Thanks, Matt. I look forward to plowing through 2023 with you. Looking forward to being a great year and wishing all the listeners a really happy, healthy, and prosperous 2023. May the holiday season be well for all.
Indeed. Yeah. I'd also like to thank the panelists from I'd like to thank Biofarm, who, unbeknownst to them, became fodder for today's conversation. The panelists who you served with, who, unbeknownst to them, were fodder for today's conversation, as well as Bruce Booth. Again, go check that out on YouTube, Atlas Venture Year in Review 2022. So yeah, hey, real quick before I let you go, is that James Taylor poster, that concert poster over your right shoulder? Is that new, or has that always been there in that office?
That has always been here in the office. It's a proud concert that I actually promoted. That concert back when I was in college. I broke the school's piggy bank to bring him up there. But nice. I told them that if we could, because prior to that, we had a saying that we could bring John Lennon back from the dead, reunite him with the Beatles, and still not sell out the hall. But we were able to sell James Taylor out pre-sale. So I was quite proud of that concert. Plus,
that's a cool story. He predates me a little bit, I guess, in terms of his peak popularity, but I'm a big fan. My kids are even big James Taylor fan. I saw him in concert a few times in his older days at Darien Lake. Very cool. Good story. Thanks for indulging me. And the other comment I'll make about your background, and again, as a reminder to our listeners, you can watch these interviews on bioprocessonline.com as well as YouTube if you want to see the video versions. But I grew up near Buffalo, New York, and I'm a Buffalo Bills fan. Allan Shaw is a big Jets fan, and I'd just like to congratulate you on your win earlier this season. We will face you again, I think, in a couple of weeks. I think the Bills come back to I think we play in New Jersey, don't we? Next game?
We actually, the game that you're congratulating was in New Jersey, so I was able to enjoy that very well.
Yeah.
It was a great time. And in the spirit of that game, I had buffalo burgers and buffalo chicken wings. I like to have sacrificial themed food for all of our games.
You can't go wrong with food from Buffalo. One thing I miss about living there is the food, for sure. Yeah. So I'll regroup with you on a friendly wager for the upcoming game.
I look forward to it.
Cool. So that's Allan Shaw. I'm Matt Pillar, and this is the Business of Biotech. We're produced by Bioprocess Online in partnership with Cytiva. Do yourself a favor, check out the great resources Cytiva's procured for new and emerging biopharma companies at cytiva.com/emerging biotech. While you're browsing, go to bioprocessonline.com/BOB to sign up for that newsletter I mentioned earlier. And if you're enjoying the Business of Biotech, please tell your friends about it. Subscribe, leave us a review. It only takes a second to click that 5th star to the right. And as always, thanks for listening.